Why strong US GDP is bad news for India? Yes, really? America's economy just grew at 4.3%, the fastest pace in 2 years. Sound like great news for the world, right? But for India's stock market, this can actually be bad news. Let's explain why. So now you are watching Trick the Tricky. In Q3 2025, the US economy surprised everyone with 4.3% annualized GDP growth. Strong growth usually sounds positive, but in today's global financial system, it creates serious problems for emerging markets like India. Strong US growth means fewer Fed rate cuts. High growth means high rates. The most important link is this. Strong US GDP means the economy is doing well. When the economy is strong, inflation risks stay alive. That means the US Federal Reserve has no urgency to cut rates. If rates stay high for longer or are cut very slowly, global money stays parked in the US. High US rates pull money back to America. Capital goes where returns are highest. When US interest rates are high, US bonds offer safe, attractive returns. US equities, especially AI and tech, keep delivering strong profits. So global investors ask why take emerging market risk when the US itself is booming. Result: less money flows into India, some money flows out of India. Why this hurt Indian stock markets? Foreign investors stay away. Foreign institutional investors are very sensitive to global interest rates, prefer strong growth and strong currency markets. In 2025, India already struggled with FII outflows. A booming US economy delays their return. This puts pressure on Indian equity indices, market sentiment, valuations, even when India's own GDP is strong. India faces a double headwind right now, rates and trade. This effect become worse because US tariff on Indian goods up to 50% in some sectors. Trade uncertainty affect expo. Strong US growth reduces urgency to soften trade policies, so India faces trade pressure and capital flow pressure at the same time. Why this is a short-term market problem, not an economic crisis. Market doesn't mean economy. This is very important. A strong US GDP hurts Indian markets in the short term does not mean India's economy is weak. India still has strong domestic consumption, resilient GDP growth 7 to 8%, large internal saving pool, strong domestic investors, DII and retail. So this is more about global money movement, not India's fundamental. The overlooked positive side of strong US growth, not all bad news. Strong US growth can actually help India in some ways. Higher demand for Indian IT services, better export demand for pharma, engineering, chemicals, global growth stays intact. But these benefits take time, are less visible than immediate stock market reactions. The core logic in one simple line: why it feels bad. When the US grows fast, money stays in America instead of coming to India. That is the real reason markets react negatively. So, in one line, strong US GDP is bad news for India in short term because it keeps US interest rates high, delays foreign money inflows, and pressures Indian stock markets even though India's economy itself remains strong. So conclusion. So yes, a booming US economy can be bad news for Indian markets not because India is weak, but because global capital prefers the strongest, safest returns first. This is a cycle, not a verdict on India's future. So if this explanation helped you, hit like, comment below. Do you think India can fully decouple from US capital flows? And subscribe for more simple explainers on markets, money and macroeconomics. Thank you.